Okay, let's dive deep today. We're looking at a specific financial number, a milestone that, well, the research suggests is way more powerful than most people think.
Yeah, forget needing six figures, $100,000 or even a million to feel like you've got some breathing room.
Exactly. We are talking about $10,000. $10,000 in liquid money.
And our goal today really is to use the data we've looked at, and this comes from everywhere, Federal Reserve reports, behavioral psychology studies, to basically show that this five-digit number, it's the critical tipping point.
The point where you flip from feeling, I guess, financially fragile to financially flexible.
That's it. And look, this isn't just about piling up cash. It's about unlocking these seven specific switches in your financial life. Things that start working for you often all at once.
Okay. Seven switches, we'll get to those. But first, let's be super clear. What exactly is this $10,000 buffer we're talking about?
Right, definition time. So think of it as your emergency runway. It has to be money you can get your hands on, like, immediately.
So cash.
Pretty much. We define this liquid buffer as cash that's right there in your checking account, or, ideally earning a bit more in a high-yield savings account, maybe a money market fund.
And crucially, what isn't included?
Yeah, this is key. It is not money tied up in your retirement accounts like a 401k or IRA. It's not your stock investments. It's not the equity in your home.
Okay. So that other money is for long-term growth. This 10 grand is purely for defense. Got it.
Exactly. Defense first.
Yeah.
And honestly, when you look at the current situation, that defense is, well, it's badly needed for a lot of folks.
The stats on financial fragility, especially in the U.S., are just, they're sobering, aren't they?
They really are. The Fed keeps showing us year after year that a huge chunk of Americans, they still couldn't cover a $400 surprise expense with cash.
$400. That's not a huge amount in the grand scheme of things.
It isn't, but it's a barrier. And if you bump that number up just a bit to a $1,000 emergency, well, the data suggests nearly 60% of people couldn't handle it without borrowing or selling something.
Wow. So if you're stuck in that cycle, just covering the basics, maybe paycheck to paycheck, you're kind of in four-digit financial quicksand, as you put it.
That's a good way to think about it.
Yeah.
So making that leap, crossing from four digits, like $9,999 to five digits, $10,000, that's your break. It's escaping that norm of just constant fragility.
All right, so let's unpack how $10,000 makes such a difference, how it turns vulnerability into actual strength. Let's start with those defensive switches you mentioned, the ones that stop the financial bleeding.
Okay, first up is switch number one. Shock-proofing daily life.
Shockproofing, I like that. It's like buying yourself a financial immune system, right? Before you hit $10, any little thing, a car repair, a medical bill, sends you reaching for a credit card, probably a high-interest one.
Precisely. And the source materials we looked at, they show that the vast majority, like maybe 99% of the common curveballs life throws at you, they usually cost somewhere between $500 and, say, $3,000.
Okay, so like a car deductible, broken appliance, maybe an unexpected flight.
Yeah, those kinds of things. When you have $10,000 sitting there, ready, you can absorb several of those hits, maybe even two or three decent-sized ones, without going into that debt spiral.
So what felt like a crisis before,
Yeah.
now it's just an inconvenience, a chore.
Exactly. Pay the bill, move on. That's the power. It changes the whole emotional landscape.
Okay, that makes sense. What's the next defensive move? Switch to.
Switch number two is where this buffer really starts to, well, pay for itself, we call it. Exiting the fee and interest trap.
Ah, the trap.
Yeah.
Okay, we often focus so much on earning returns, right? But you're saying the first win here is stopping the losses.
It's the guaranteed win. Avoiding overdraft fees, NSF fees, those just disappear. That's the easy part because your balance isn't constantly hovering near zero.
Low-hanging fruit.
But the real leverage, the big one, is breaking the reliance on high APR credit card debt. Right now, if you carry a balance, the average interest rate is bumping up against, 22, maybe 23%?
Oof.
Avoiding that guaranteed 23% loss. Mathematically, that's way better than any safe investment return you could possibly make right now. Every dollar you don't pay in interest is a dollar you can keep, or even better, put to work.
So it's not just the interest cost itself, it's the lost opportunity. That money could have been growing for you instead of costing you.
That's the double whammy, yes, opportunity cost. And, that stability, that freedom from high interest debt, it leads right into another really interesting bit of leverage. Switch number three.
Okay.
The deductible advantage.
The deductible advantage. Now, wait, that sounds a bit backward. If I only have $10,000 saved, Why would I want more risk by raising my insurance deductibles?
Yeah, it seems counterintuitive, but think about the strategy. When you don't have cash readily available, you're basically forced into choosing low deductibles, right? Maybe $500, perhaps $1,000.
Because you can't afford to pay more than that if something actually happens.
Exactly. You can't cover the worst case scenario out of pocket. But that choice, or lack of choice, means you pay higher insurance premiums every single year. You're essentially paying extra, sometimes a lot extra, to insure against relatively small shocks.
Ah, I see. So having the $10,000 buffer means I could choose, say, a $2,000 or $2,500 deductible on my car or home insurance because I know I can actually cover that cost if I need to.
Right. You have the capacity.
Right.
And the payoff, well, the numbers vary, obviously, but some sources suggest moving your auto deductible from like $500 up to $1,000 can cut your annual premium by 20, maybe even 25%.
Wow, that's significant savings year after year.
It can be. You're using that $10 as a strategic tool, right? You stop overpaying the insurance company to cover risks you can now afford to self-insure, essentially. You trade lower annual costs for a higher potential, but less likely one-time cost.
Okay, that's a smart play. Great leverage. All right, last one on the defensive side. Switch number 4, improving the credit profile. How does having cash-in savings help my credit score? Savings accounts don't report to the bureaus, do they?
They don't directly report no, but it's all about the behavior that the cash enables. First off, the buffer means you're basically never late on payments. Late payments are killer for your credit score, the single biggest factor.
Right, avoids the big negative marks.
But there is a more subtle thing, too. It means you don't need to carry high balances on your credit cards month to month. Credit scoring models absolutely love, low credit utilization.
Meaning how much of your available credit you're using at any given time.
Exactly. Keeping that utilization in the single digits, like under 10%, is ideal. Having $10,000 liquid lets you pay those cards off in full every month consistently.
Which boosts your score over time.
And critically, leads to cheaper loans down the road. Mortgages, car loans, everything becomes less expensive when you have strong credit, so the buffer pays off again indirectly.
Okay, so 4 switches just on defense. Stopping the bleeding, avoiding fees, cutting insurance costs, building credit. That's already huge. But now we shift gears, right? We go on offense.
Yes. Now we move from just protecting yourself to actively activating growth and leverage.
All right, bring on the offense. Switch number 5.
Switch 5 is where compounding gets loud.
Ah, compounding. You know, before you hit a certain point, it feels almost invisible. Like you earn $10 interest on $1,000 in savings and you think, big deal. It's kind of demotivating.
That's a huge psychological hurdle for people just starting out. But when you cross that $10,000 line, the actual dollar amounts start to feel, well, significant.
How so? Give me an example.
Okay, so if that $10,000 isn't just sitting in cash, maybe it's invested reasonably. Let's say it earns something like the long-run historical average for U.S. stocks, maybe 8 to 10% a year.
Right.
Well, suddenly, that $10,000 is generating $800 to $1,000 per year. And that's before you add a single new dollar from your paycheck.
Okay, now that feels different. 800, 1,000 bucks. What does that feel like in real terms?
Well, think about it. That could cover your streaming services for the whole year, maybe your cell phone bill. For some people, that might even cover their entire annual utility costs. It feels like real money, like found money almost.
Yeah, it's not just pennies anymore.
Exactly. And this is the point where you really internalize that key insight. The next $10,000 actually comes faster, because your existing money is now working alongside you, helping you save more. You go from just grinding it out to actually building momentum.
Momentum, I like that. That feels powerful. And that momentum, I guess, leads into the next switch, number 6.
It does. Switch number 6 is about unlocking real investment options and timely funding. This isn't just about how much you invest, but critically, when you can invest it.
Okay, explain that. How does having $10K liquid affect timing?
Financial readiness just creates massive advantages. Let's take IRA contributions, for example. For 2025, the limit is $7,000 for most people.
Right, $8,000 if you're 50 plus.
So if you're living paycheck to paycheck, struggling to save, maybe you only manage to max out that IRA contribution in, like, December, right before the deadline. You scrape it together at the last minute.
Yeah, that sounds familiar for a lot of people.
But if you have that $10,000 buffer just sitting there, accessible, you have the flexibility, the option, to fully fund the entire $7,000 IRA contribution in January, day one of the year.
Ah, so you get your money working for you for the whole year instead of just a few months or weeks at the end?
Exactly. That's potentially 11 extra months of compound growth working for you, tax advantaged. That simple $10,000 buffer changes your entire investing posture. You go from scrambling to catch up to strategically maximizing your most valuable asset, time in the market.
So investing starts to feel less like a gamble you can barely afford and more like controlled, deliberate growth.
That's the shift.
Yeah.
It's huge for confidence, too. #2, the
Yeah.
non-monetary shifts, mindset and freedom.
Okay, so we've covered the dollars and cents impact. 6 switches focused on the mechanics of money. But there's one more, right? Switch 7 sounds different.
It is, because if the first 6 are about your wallet, switch number 7 is really about your brain. This is buying back cognitive bandwidth and clarity.
Cognitive bandwidth. We hear about financial stress all the time, but the research on how it directly impacts your mental capacity is actually pretty startling.
It really is. There's solid, peer-reviewed research showing that financial scarcity, that constant background hum of worrying about the next unexpected bill, that $400 emergency we talked about, it measurably reduces your cognitive function. Meaning, when your brain is tied up juggling financial worries, you literally have less mental energy left over for other important things like complex problem solving at work, long-term planning, making good decisions, even just focusing.
Wow. So that $10,000 isn't just paying for, say, a potential car repair.
Yeah.
It's also buying you the mental space, the clarity to maybe negotiate a raise or look for a better job or even make healthier choices in other parts of your life.
You got it. It buys clarity, not necessarily luxury items. And that same research connects having cash on hand, that feeling of a liquid buffer, directly to higher reported life satisfaction.
Even if your income hasn't changed.
Even controlling for income, yes. It's the sense of control that seems to be the powerful ingredient, which leads us naturally to the ultimate non-monetary benefit, just freedom and better choices.
Okay, this sounds like the classic walking away money concept.
Uh-huh.
How does that actually play out for someone with a $10K buffer?
It means you're not making critical life decisions purely out of financial desperation. Let's say you're in a job you hate, maybe it's toxic, bad boss, whatever.
Yeah.
That $10,000 buffer, it acts like an immediate escape hatch. You don't have to stay just because you absolutely need next week's paycheck to keep the lights on.
I have breathing room.
You have breathing room. You could potentially walk away, take a month or two, be more selective, and find a new opportunity that actually fits your long-term goals, your values, instead of just grabbing the first thing that comes along.
That's a fundamental shift, isn't it? From scarcity thinking to, well, something closer to abundance. You stop asking, what's the absolute cheapest thing I can do to survive?
And you start asking, okay, what's the best value option here? What choice helps me actually design the life I want? That psychological upgrade, honestly, you can't put a price tag on it. #Nan nuance and action plan.
Okay, this is all incredibly compelling. 7 switches kicking in at $10,000.
Yeah.
But the obvious question, maybe the pushback, is, if $10K is so powerful, why do we always hear the standard advice is, 3 to 6 months of living expenses for an emergency fund, which is usually way more than $10,000?
That's a fair question. And the answer is that 3 to 6 month goal, that absolutely remains the gold standard for true, robust financial security. Think of $10,000 not as the finish line, but as the first really meaningful plateau.
Okay.
It's the point where all those positive feedback loops, those 7 switches, really start to activate and gain traction. It's where the momentum begins. So, yeah, it's not the end goal, but maybe it's the end of the beginning,
The end of the beginning, I like that. But we absolutely have to add a critical warning here, right?
Right.
Especially for anyone listening who's maybe been using credit cards just to get by.
Yes. Crucial caveat time.
If you're carrying high interest debt right now, like that 22, 23% APR credit card debt we mentioned, should your first priority still be sprinting to save $10,000 cash?
No, absolutely not. Not beyond maybe a very small starter cushion, like $1,000.
Right on.
Because that guaranteed 22 or 22% return you get by paying off that debt, it mathematically crushes any safe return you could possibly earn on savings right now. You have to eliminate the biggest financial threat first. That high-interest debt is an emergency in itself.
Okay, cannot stress that enough. Get rid of the high interest debt first.
Please, yes.
So with that major caveat in mind, the path forward seems pretty clear then. Based on everything we've discussed, what's the action plan? How does someone get to this $10K tipping point and activate these switches?
Okay, distilled down, it's basically a 4-step process.
Yeah.
Step 1, get to $1,000 fast. Like really fast. That's your tiny initial buffer. Stops the bleeding from the smallest shocks, lets you breathe for a second.
Step 2.
Step 2, attack that high APR debt with everything you've got. Use that $1,000 starter cushion as your safety net so you can throw every other available dollar at those 20% plus interest balances without constantly fearing you'll fall back into overdraft fees or need the cards again immediately.
Okay, 1K buffer, then debt demolition. Got it. Step 3.
Step 3. Once the nasty debt is gone, then you sprint to $10,000 liquid. Focus all that energy you were putting into debt payments, into saving. Park the cash somewhere safe and accessible, ideally a high-yield savings account so it's earning something while you build it up.
And finally, step 4. Once you hit the $10.
Step 4. Implement the leverage. Start putting those switches to work for you. Call your insurance agent, ask about raising deductibles, see if the savings make sense for you. Consciously keep your credit card utilization super low and use that liquidity advantage, maybe front load your IRA or other tax-advantaged accounts early in the year. Start designing the system. Hashtag tag outro.
So wrapping this up, what this deep dive really shows is that hitting that $10,000 milestone, it fundamentally shifts your financial identity, doesn't it?
I think it does. You stop being someone who's just trying to save, maybe struggling, and you become someone who actually does save. You have proof.
You replace that constant nagging uncertainty with actual evidence of progress, and maybe trade some of that financial fear for, well, a bit of psychological peace.
Yeah, it really is the shift from just surviving month to month to actually starting to design your financial future.
From fragile to flexible.
Exactly. And maybe here's the final thought, the provocative idea we want to leave you with today.
Okay.
Once you actually feel that calm control that comes with having this kind of financial leverage, even just at the $10K level, you'll likely find you stop chasing quick financial wins or stressing about market noise.
And you start doing what instead?
You start thinking more systematically. You start designing financial habits and systems that work for you consistently, even when you're tired, even when life gets messy or uncertain.
That makes sense. So if you're listening and you're currently at, say, $500 or maybe $2,000 or somewhere on that path, the gap between where you are now and that $10,000 mark, it's not really about distance.
No, it's about consistency. That first $10,000 is often the hardest climb, no doubt. But reaching it, it feels like it grants you the permission slip you need to start writing your next chapter.
Well said. Thanks for diving deep with us today.